right, happy Saturday. And for you all that are watching the replay, happy day, whatever day it is for you. So we are going to go ahead and get started with our tax strategy workshop. We will begin with some portions of personal taxes, but then we're going to transition into business taxes and how the two will, kind of work together. So let's get started. I'm so excited and glad to have you all here. And so I am going to do this really quick. I want to make sure that I get everybody together. If this would be a good time to get any questions jotted down in regards to the upcoming filing season, anything that you're thinking of doing this. And one of the reasons why I like to do tax planning is because in this time of the year, because you have time to go back and make changes, all right? You don't want to do tax planning when it's tax season, when it's time to get the ball rolling. So now we've had a good bit of time to get everybody in. All right, so a little bit about me, who I am, and what qualifies me to be able to share this information with you guys on today. I'm a financial educator, teach people how money works, whether that's for personal or business. I have an Associate of Science degree in marketing, advertising, and business management. That kind of plays into the business part. I'm a registered tax professional for individual tax returns and for business tax returns. And I have over 2 decades of experience in taxes and finance. And I'm also a licensed insurance agent. So just about everything we're going to talk about today, not only do I have the formal education for it, but I also have life lessons, which usually weigh more than the credentials. All right, so tax strategy. What's the importance of having a tax strategy? Why would you want to have, why have a tax strategy? This will keep you from leaving things to chance, just kind of, winging it, just kind of saying, hey, I'll figure it out. A tax plan can help you save money. It can help you increase your income and achieve better results. And I always tell people, a lot of times I'll get a question where if I do tax planning, will I still have to pay taxes? Chances are you may still have to pay taxes. The key to it is, in a perfect world, we would have a zero. I mean, you don't owe the IRS, you don't owe the state, and the state don't owe you, and the IRS don't owe you. If we can get all the tax returns to zero, that would be perfect. And that means if you don't owe them, you get to keep your money. And if you don't get a refund, that means you already got your money. So the whole purpose of it is to get close to zero as possible on both ends. I would rather you keep your money throughout the year, use it where you need it, versus having to wait for once a year tax refund to put the funds where you need it. Because chances are you need your money all 12 months, not just in February. And then also a tax strategy helps you better prepare for a tax audit. I tell everyone, getting audited is not a bad thing. Getting audited and not having your paperwork together is a bad thing. So a tax plan helps you prepare for an audit. All right. So here we're going to go over some personal tax items, and this is kind of where I'm just going to, I got the bullet points on here. Now the tax code are pages and pages and pages long, so there's no way we're going to get all of it today, but I'm going to do my best to cover as much of it as possible. All right. So the first one I want to kind of go over is documents. What are some of the personal 1040 documents that you would want to include on your tax return? What are some of the things that will allow you to file your taxes? That's the W-2, you need driver's license. Some tax professionals do require Social Security cards. For me, I only require them for dependents, but that could vary. So Social Security cards are sometimes one of the things. All right, ladies, hang on one second. I am getting a lot of people standing in the waiting room. So let me see if they are on if we had two different links. So y'all just give me 1 second, okay? Sorry about that. And to those of you who are watching the recording, welcome to the world of technology. Just kind of how it goes. So hold on. Since they're figuring it out. All right. Thank you for joining us, Mr. Walker. Thank you. Thank you. Thank you. All right. All right, so documents. A lot of times that may look like W-2, 1099, ID. And let me say something really quick about photo IDs. They cannot be expired. Whether you are filing electronically or mailing it, your IDs do need to be updated. The IRS will reject it. Any special forms, any special withholdings, whether you took money out of your retirement, or you investing in stocks and bonds, or you donating to a charity. And just to kind of clarify charity document, if you're giving contributions to your church, United Way, giving clothing items to the Salvation Army, anytime anything is over $500, you want to make sure that, well, if it totals over $500 altogether, you want to make sure that you have a paper trail. That could be, your bank statement where you can highlight showing that you donated to this organization. Or you can ask the donation for a contribution letter. You can, any receipts, anything that you have, you want to make sure that you keep a paper copy of it, scan it in digital if digital is your thing. A good rule of thumb, keep all your tax documents 3 to 5 years. Usually tax audits go back 3 years. But the IRS is getting a little bit better. So having 5 years won't hurt. Typically after that, you can discard paperwork. And I know that sounds like a lot, but it's always good to have your ducks in a row, have your bases covered. Tax credit, that is going to look like, I got a text the other day. Someone said, I'm buying a new Tesla. I said, oh, that's nice. So they're buying a new Tesla and they wanted to know what were the tax credit. So sometimes you can do research to find out, if I make this major purchase, is there a tax credit tied to it? There are certain appliances you can purchase in your home, window replacements. There are all sorts of things that will yield a tax credit that you can use to claim on your tax return. If there are other tax credits, if there's a natural disaster and your zip code qualifies for a tax credit, you can simply look that up by going to the IRS website, clicking on natural disaster or putting it in the search bar, and it's going to take you to the IRS page for natural disaster. You're going to put your zip code in, and I believe you also have to put what year. And it's going to tell you what state had a natural disaster credit and what that looks like. So you want to make sure, that's why you do the tax planning. And this is a great time to do that, because this will give you time to research and look and see what else is out there. Generally, a good tax professional will know, when preparing the taxes, to go and find credit for their client. However, tax planning on your part, it's great to do it before the year ends in case you do need to put some things in place or go find certain documents, you want to do it before the tax year starts. So for example, everything that happens in 2023, you want to gather it together and have it ready for January 1 for tax filing. Sometimes you'll find out, oh, I should have done X, Y, Z. It'll be too late to make any changes. So doing tax planning now will help that. And there are tons and tons of tax credit. And I'll say this as well, tax credit don't mean you get dollar for dollar. So that means if you spent $1,000 donating to a charity, that doesn't mean if you owe $3,000 to the IRS that they're gonna automatically take $1,000 off your tax debt. That's not how that works. Credits are allocated based on percentage, and quantity and other rules and things that factor in. However, I always tell clients, write everything down. We'll go through the list and determine what is a legit tax credit that you can claim and what is not. So it's better to have too much information and than to not have enough. All right, filing status. And let me say, these items are not in order of importance. So like I said, it's hundreds and hundreds of things we could have talked about. I just pulled these few things out to kind of get the discussion going. Filing status. There's married, filing joint, married, filing separate, widow, single. So I want to talk about the differences of those because a lot of times people could kind of get confused. So let's say you're a newlywed or just got married, and a lot of times people say, well, we didn't get married till December. We had a Christmas wedding. Do we still need to file together? The rule is always going to be yes with me, because you get more of a tax credit filing married, filing joint versus filing single. There are just more credits out there available for married couples. However, you do have the option to finish up the year, both of you filing single returns. I get that question a lot. And so one of the caveats of filing married, filing joint, aside from certain tax credits, there's also a way of getting the finances together in the house. Meaning that all of the income is pulled together and then the best of the tax credits can be taken because the tax professional now have a full out view of what's going on, how are the finances working together. So married, filing joint means you're equally responsible for tax debt. It also means that you are equally you're equally able to receive whatever credits that come in as well. Now, if one spouse has a tax debt that the other spouse did not help to incur, so for example, if you just gotten married and you've been married 2 or 3 years, but you have another spouse, this is a very common one that I get, that owes child support and may have it a past due child support or past due student loan, or things that can levy any refund. There is a form that you can include into the tax return, married, filing joint, and then there's a form that called an injured spouse. The injured spouse tax form says, hey, we are married, we live in the same household, here's all of our income. However, when it comes time to pay the tax debt that the IRS has a lien on, I'm only responsible for this portion. The other spouse is responsible for their portion. So the refund gets split according to which spouse had what. So it's essentially 2 returns into one. It is the best way to file if you are married and one spouse has a tax obligation that was incurred prior to the marriage. After the marriage, the inter-spouse form does not apply in most cases because the IRS may contest that. I've had people to still file it, but it generally works if the debt was incurred before the marriage. So what happens in that case, if the spouse that owed the debt, any part of their refund will go toward the debt. The spouse that did not have the debt will still get their refund. All right, so that's kind of how that works. Married, filing separate. I generally, I guess this is my professional personal or personal professional opinion. I don't like that tax filing status because it takes most of all the tax credits off the table. No spouse gets most of it's like all the credits, like earned income credit comes off, and there's a whole list of credits you cannot receive if you're filing married, filing separate. However, generally, the only time that is a good time to use that is if in that current year, there's a divorce in place, or the divorce is in progress, or the divorce took place. That is about the only time that would be advised to file married, filing separate, because whenever you're in the same household, you are operating as a married couple, but then you use married, filing separate, all tax credits usually come off the table, which means both parties will have a higher tax liability. In a sense, don't really make sense to file that status. Single, just what it means. You don't have any, you're not married, and typically no dependents. Now you can file single with dependents, and I would ask your tax professional advice. Should you file single, or should you be filing head of household? Head of household means you're not married. There is no spouse in the tax return. However, you do have dependents, and dependents don't always mean children. Dependents could be you're taking care of a mother, you're taking care of a niece, you have an uncle, you have a brother or a sibling. Dependents don't just mean your natural children. Dependents means anyone that relies on you for financial support, and they resided with you throughout the year. Even if it's not the entire year, but for the majority of the year, they resided with you. A lot of times people get in trouble with this one because they say, hey, I got a sister that lives, I live in Louisiana, my sister lives in Arkansas, but I send her $400 a month. I'm going to claim her on my taxes. You cannot, the rule is they have to reside with you. So that kind of clears that up. So how would you take advantage of the credit if you're giving your sister $400 a month? What happens to that? Then that would become a charitable donation, which means you have to issue her a tax form and all that. We can get into that a little later if that is your situation. That can just kind of be a whole nother class on clarifying who dependents are. But the rule of thumb, to claim someone on your tax return as a dependent, they have to reside with you. They have to rely on you for financial support. Another question I get about dependents is, well, my son or my daughter or my niece that lived with me had a job. Can I still claim them? Yes, you have to earn $1 more than they did, and then you can still claim them. So if you have children that are in high school or college and they're working, don't leave them off your tax return if you are in fact taking care of them. I'm sure your child working at McDonald's is not taking care of the mortgage and the insurances and the food and all of that. So don't leave that tax credit off the table. College students, I get that question a lot. Can I claim my college student? Yes. How old can the dependent be? There is no limitation on the age of the dependent. What the difference is, if a person is in high school, the credit is one way. If they're in college, it's another credit. If they're not in college, if they're disabled. So there are different tiers of tax credit you get for dependent, but there is no age restriction. You can claim someone that's living in your home that's 40 years old as a dependent, long as you provide financial stability to that person and you earn $1 more than they do, and they reside with you. That is it. That's the only, those are the basics. Let me say that. I don't want to say that is it. That's the basics of claiming a dependent. All right. So if someone is working, do they still file their taxes? Yes. So you have to be very careful here. A lot of times, parents, I get it all the time. I was going to file my child, but they were at school and in college, away at college, and someone filed their taxes as a single person. Okay, if they file as a single person on their own, you cannot claim them as a dependent. So you have to be very particular about how you and the dependent file the taxes. The college student has to file what's called dependent of another, DOA. I don't like the acronym, but hey, that's what it is, dependent of another. So if they file dependent of another, that means you get to claim them as a dependent and get the full tax credit, and they still get to file their taxes, and any federal or state taxes they paid in, they will receive that back. All right. So any discrepancies or any concerns about dependents, you can kind of write that down. We'll take some Q&A at the end to, kind of help you with that, or you can schedule a consultation where we can get that offline. And so I'm going to kind of recap the personal, and then we're going to kind of shift over into the business part of this section where we're going to spend most of the time. Now, documents, like I said, or any tax form that you are getting from employers or from entities such as you took money out of a 401k, you sold a home, you inherited some property. Sometimes that stuff is taxable, it's not taxable. So it just depends. If you have charitable donation slips, all of those documents, make sure your license is valid. I get so many clients, at least 4 or 5 a year, they come to file their taxes and their license expired like 3 months ago. I'm like, hey, you're driving around with an expired license. So you might want to double check your license. Some tax professionals do require Social Security cards. I only require it if you're a client of mine, or thinking about being a client, I require it for a dependent. Everyone 18 or older, I require valid either state ID or driver's license, or a military ID. But the military ID cannot be expired as well. Tax credit, we talked about seeing if the vehicle purchase has a tax credit, appliances in the home, certain home repairs may have tax credit, natural disasters, donations. So there's a slew of tax credits that you can qualify for. Do your research. Do not wait until they are filing to see what you can scramble and put together. So many people leave credits off the table with essentially sometimes would be more to the refund or a reduction in the tax liability, but they leave the credits off. Check your filing status. Make sure that you're taking advantage. See what your options are. You may do better filing one way or another. See what your options are. Tax liability. Make sure that if you have a tax debt that you know what it is. Understand why you owe. If you find yourself owing a tax refund, find out why. What is causing you to owe taxes? You want to know that. Dependent. What classifies as a dependent? It is really good to find out. You just may never know. You may could actually claim someone as a dependent. And then, of course, I just mentioned that I do offer no cost consultation for that. I'll give you more information at the end of how to schedule that. And so what I want to do, let me see if I have any questions in the chat. Okay, so we're going to make sure that we get to your question there. All right. So a lot of times people say, well, I don't own a business, so I just need the personal part. But I would have, I want you to stay tuned in, even if you don't have a business. Stay tuned to this next section because this could potentially help you or help someone in your family. And so I want to make sure that, that you have the opportunity to hear it all out. If you do not have a business, here's one of the benefits of owning one. It allows for tax breaks. It helps build legacy for your family or for yourself, if you just want to build a legacy for yourself. And it also helps you generate income. So if you don't have a business and you owe a lot in taxes, you may want to reconsider that. All right, so this next section, I'm just going to kind of clarify. And if you've been in business a long time, stick around. This is still good information. This will be a good refresher for you because sometimes things change and you may need to shift from one thing to the next. Now, what you don't see on here is what's called a solopreneur or a sole proprietor or a gig worker. I don't have that on the screen. However, I'll just kind of give you a short of that. That may be someone who just occasionally does something or a paid hobby. But if you've moved beyond just having a paid hobby or you want to establish your business to take advantage of all the tax credit, you want to decide one of these three options here for you. You want to see if you want to be an LLC, a corporation, or an S corp. So I'm going to, there's the the fancy definition on the screen, take a picture of that. So I'm just gonna put it in layman terms, or how it has been over the years, through my dealings with small businesses. I have a heart for small businesses. That's kind of like a soft spot for me. So just bear with me as I go through here. But as you see, an LLC stands for limited liability company, and that's just what it means, that you kind of negate having the responsibilities as an individual to anything that goes on with the business, whether it be income or incidences. And what I mean by that, if you are set up as an LLC and your business, I'll use it for an example. Let's say you do roof repairs, all right? And for some reason, you're doing a roof repair and you put a hole in the ceiling and it messes up the homeowner's furniture. Just kind of get an idea. If you do not have an LLC, you're personally responsible for that, meaning that if you own a home, that person can sue you and put your home as one of the things in the court doc that they want to see where they can get the income from, where you will be forced to sell your home to be able to pay that debt off. Whereas if you have an LLC, they can only sue the business, which typically means the business has insurance and all those other things, and we'll talk about that a little bit more. So an LLC puts a barrier, not just for taxes, but it also puts a barrier between you and your business. Whereas you are a separate entity, the business has a life of its own. You just so happen to be the owner of it. So it puts that break in there as well. Then the taxes, and we're going to talk about the pass-through, how the tax obligations and how the tax breaks work for an LLC. We're going to discuss that. If you, and then for an LLC really quick, when you file your taxes, you're gonna file that on what's called a Form Schedule C, which means you file it when you file your 1040. The next option you have is a corporation, which I'm gonna say this, you can be an LLC and you can change your tax code from an LLC to a corporation. However, you cannot go from a corporation to an LLC. So you want to make sure that if you're going to transition from an LLC, that you're going to move over to a corporation. If you should do that, the IRS will issue you a new tax ID number. You can do that. You can say, hey, my business has grown past an LLC. We are now ready to be a corporation, which is great. Hats off to you. Just know that now you're going to have a new EIN and you're going to have separate tax filing, which means you will file your 1040 for your personal taxes. And now you have to file a corporation tax, which is tax form 1120. Whereas if you were an LLC, you would file just a 1040, and one of the documents inside of the 1040 would be the Schedule C, which means you have one tax bill. But when you transition over to a corporation, you now have two tax bills. You have one for your 1040 and you have one for the business through the corporation. Now, S Corp, this is the one that kind of gets tricky and is very misused, if you're doing a survey. So an S Corp, so I'm going to spend a little more time explaining this one. The first two are kind of self-explanatory, or we can come back. We will get to some more of that through the next few slides. But then S Corp, I'm going to actually read this definition here. S corporations are corporations that pass corporate income, losses, deductions, and credits to their shareholders for federal tax purposes. To file taxes for an S corporation, complete tax form 1065, and don't forget to include the K-1 form. All right, so S Corp is the S stand for shareholder. So if a corporation transitions over to an S Corp, or if you originally set the business up as an S Corp, you're saying that there are shareholders that own stakes in this company, which means you're going to have more than one. So a lot of times I see people that are single member S Corp, and I'm like, that doesn't really go together. S Corp means you have shareholders. which means there are people that have put money into this company to set it up, and they are recipients of all income and profit earned by the business. Meaning that if the S Corp makes $1,000 in 2023, and the expenses are $500, well, the profit is $500. So that $500 has to be allocated in a form of a K1 to the shareholders. If it's two shareholders, that means they, however the split is, let's say it's a 50-50 split for the sake of the example, each shareholder gets a K1 for $250. If there are 4 shareholders, that means they each get one for $125. And the K1 forms is what the shareholder will file on their 1040. So oftentimes, companies, for whatever reason, will set themselves up as an S Corp, and it kind of defeats the purpose, because now you have to take the income and file it on your personal taxes. Well, that's great if you have shareholders, because now if the business profited $500 and you have 4 people, that means technically you only have to claim $125 on your personal taxes. Whereas if you're a single member S Corp, which is really not accurate, but there are some single member S Corp, if the business profited $500, all you've done is shift the tax liability from the S Corp to you personally. So now you personally have to file the $500 on your personal tax return, not on a business return, which means you don't get any deduction credits and all those things for that. The purpose of an S Corp is to allocate the profit sharing to the shareholders, okay? And what that does for a company is reduce the tax liability for the company. Well, if the company is going to take a reduction and give the income to the shareholders, if you're the only shareholder, you're going to be responsible for 100% of the earnings. Should that be confusion or you need more explanation, feel free to reach out to me. I always say everything is case by case, but there are some general rules of thumb. Make sure that you talk to your tax professional before you make any major changes in your tax filing. All right. And I saw your question. It says, along with my business, I have an S Corp. How do I file the necessary paperwork for both? Can one person help with both? If so, what kind of person do I need? Yes, a tax professional can help you with both of those. The S Corp, LLC, incorporation, those are all part of tax filing. The only difference is that what type of form you file. The process is still the same. It just means instead of filling out Form A, I'm going to fill out Form B. That's pretty much it. And so there's nothing special you would have to do that. A tax professional can do that. You can get a CPA, you can get an accountant, or you can get a bookkeeper. It's just your preference. All right, so what is profit in your business? So I'm going to kind of get into some of so now that you got the decision of what business should I set up, or if I have a business, let me reevaluate and make sure that I'm set up correctly. Now let's get into some of the tips and resources and things that can help you with your tax strategy. Sure, I don't have any questions. All right, can everyone see the slides? If you can see the slide, please put it in the, oh, let me go back. I don't think you guys can. Let me go back. All right. All right, so can you see the slide now, the LLC S Corp? Okay, great. I'm gonna let everybody take a picture of that. My apologies. All right. And then I'm just gonna go back to the beginning to make sure that all the slides got in there. And you will get the replay, so you'll be able to go back. And thank you, Mariko, for pointing that out. All right, so All right. So what is profit in your business? What's the idea of the pass-through entity and how profit is calculated for the small businesses? So when you own a small business, and you're filing it as an LLC, let's talk about that. Let's talk about that option first, okay? You get to, so you have your personal 1040. If you're working a job, you got a W-2, you took money out of your 401k retirement, you have that form. You have all your Social Security withdrawals, all those things go on your personal. So when it gets to the business filing, well, let me go back. And you have your earnings, your gross, and then you have all your deductions, and then you have your net. However, with a W-2, you pay taxes on the gross, which means you pay taxes first. Before your deductions, you pay taxes. So if you make $100 and your deductions are 50, and you bring home 50, you pay taxes on the $100. Okay. Whereas in a business, you pay taxes last. Meaning if the business makes $100, you have $50 worth of deduction, and you have $50 profit, you pay taxes on the $50. Okay. So that's hopefully, I'm all for entrepreneurship, all for small business ownership. So anytime that I can offer an incentive for starting a business, I'm going to use it to my advantage, and that is one of them. You pay taxes on what's left, not on what you start with. Versus with a W-2 job, you pay taxes off the top. They don't even give you an option. It just comes right off the top. Okay. So a pass-through means you get to claim some of the deductions that you otherwise wouldn't if you did not have a business. Okay. The profit is calculated just like I just stated. You have all of your earnings and record all of your earnings. A lot of times people bring the tax preparer the end result. No, so let's start from the top, and I'll explain why later. But you want to have all of your income, and then you subtract all of your expenses, and then that's how you calculate what the profit is. So if the business made $100, all your expenses were 50, the business profited $50. If the business made $100 and the expenses were 150, well, the business is in the negative $50, which means it has a profit loss of $50. Okay. And if you're wondering about the tax implications of your business structure, this is a breakdown. You can take a picture of the screen. And so there are no federal tax on an LLC, and I'll let that make sense. For a sole proprietor or a single member LLC without an S Corp election, file the tax return and put the business information on a Schedule C. Meaning that the business does not file taxes by itself. So the business does not have any federal tax implication as a business owner in an LLC, because everything is going to flow on the 1040. All the business reporting is going to be on a Schedule C. For partnerships, you want to make sure that you're using tax form 1065 through filing the LLC partnership, should I say? I should have put LLC partnership. You're going to file the form 1065. If you are operating as an S Corp, you will file a separate tax return on an 1120. Okay. So that is the difference. On a state level, that is a whole nother topic. But on the federal level, there is no tax form for the business to file for an LLC business to file by itself. It has to be attached to the 1040 personal tax return. All right, so another hot topic that I get a lot of questions about often is, how do I pay myself? So right off the bat, let's have two separate accounts. One for your personal, one for the business. The business needs to have its own tax account, which means you have to be registered as an LLC with the federal and your state, so that you can generate what's called an EIN letter, because the bank will require that. Some banks require, certain things, but at the top of the list, you have to have a tax ID number, which you will get an EIN, which is an employee identification number letter, when you register your business. You will take that to the bank, and the bank will allow you to open a business bank account, along with some other things that they may require. Different banks want different things. But the main thing is to have a tax ID number for the business, all right? When you have that account, all of the income from the business goes into it, and then from there, the expenses come out, which we're going to talk about payroll, which is generally a long list of expenses that you can claim. Do you have to have a separate bank account for the S Corp? If you have, let's say you have, I'm sorry, that was a question that was in the chat. I'm going to answer that really quick because that's a good question. So if you should have a personal bank account. Let's say you have an LLC and an S Corp. Let's say you have one LLC business and you do this, and then you have an S Corp. You will need 2 separate bank accounts for those. I'm not going to say that it's mandated by law, but I'm going to tell you in an IRS audit, you would want to have 2 separate bank accounts because of some of the rules and regulations and credits and things of that nature. Every business should have its own standalone bank account. If you have multiple businesses, each business should have, that's registered, each business should have its own bank account with its own EIN number. It makes for better bookkeeping, trust me. All right. So when we get into paying, there are going to be a few options to consider. And the reason why I mentioned the bank account is because you don't want all your money going into your business bank account, and then you're using the business debit card or the business checking account or the business making withdrawals for personal use. So for example, the business earns $1,000, great day, right? The money goes into the business bank account, but you remembered you need to pay your personal light bill. You don't take the debit card and go swipe it and pay for that, or to buy groceries for your home. You do not use the business in that regard. What should take place is the business pays the employee or the independent contractor, and from there, they can do whatever they want with the money. So the business earns $1,000, and you say, hey, I need 500 of these dollars. The business should pay you in some sort of format, whether it's through an electronic direct deposit or a payroll check or a company check. There should be some filter between you and you withdrawing the money from the business bank account, not using your business bank account to go buy candles for your living room. You have to separate, take that process, put that, and the beauty of it is, it's your company. You get to decide how much you earn. So you can say at the end of the week, I'm paying myself $999, out of that $1,000 that the business earned. It's your money. You just need to have a reasonable, something in place, something. And I'm going to talk a little bit about S Corp. That rule is a little different. So right now I'm referring to LLC at this point, and then we'll talk about corporation and S Corp, how that works. So right now we're talking about an LLC because it's the most common. An owner's draw is where the owner just used the business bank. They didn't do any payroll. They just said, hey, I need to transfer $500 from my business bank account, and I just need to transfer it to my personal, especially when their accounts are at the same bank, which is one of the reasons why I say put them at 2 different banks, make it even harder so that you can remember on purpose to take that extra step and pay yourself. Whenever the owner just transfers the money without any formal payroll, that becomes an owner's draw, which also means it's not tax deductible, okay? So I'll talk a little bit more about that. An owner's draw does not reduce the company's profit. An owner's draw is just the money was moved somewhere else. That's just what happened with the money. It did not reduce it. There was nothing put in place. owner's draw is not the same as a payroll deduction. Setting yourself up for payroll is what allows you to take advantage of the tax deduction. Having an owner's draw just means you move the money from here to there. It had no bearings on the tax obligations or nothing like that. It's just what happened to the money and where it went. That would just be for your own personal FYI. If you are looking to take the credit of payroll, you will want to pay yourself. Put yourself on payroll. It's no different if you worked at a major retail store and got a check at the end of the week. You're the owner of that retail store and you're paying your employees, which you just happen to be one of them. 1099, if you're going to, and you have two ways that you can pay yourself, W-2 or 1099. So I'll go over that really quick. If you pay yourself as a W-2 employee, which means you'll have payroll, taxes, unemployment, you get to pay into Social Security and all those sort of things, okay? Or you can say, no, I'm just gonna pay myself as an independent contractor and issue a 1099 at the end of the year. You can have that option. And then also know that if you are a registered LLC or a corporation or S corp, there are other things you can put in place to build your retirement. That is a topic for another day. Please register for the master classes. We will be talking about building retirement and legacy and all that sort of thing. But today, just know that there are other options if you're not on a W-2 payroll deal, that you can still save for retirement and you can still pay into your Social Security. That is another session for another day, but know that that is an option. So as a W-2, you put yourself on payroll, or if you issue yourself a 1099, you can take the tax deduction at the end of the year. Yes, it's an extra step, but it is also something that just goes along with being a business owner. You got to remember, if you own the business and you have employees or you have independent contractors that you outsource work to, you are obligated to give them a W-2 and a 1099 at the end of the year so that they can do what they need to do with their tax filing. And so really quick, I want to kind of just throw something in there about employee versus, well, I'll come back to that. I'll come back to that because I kind of want to stick on payroll. And just know that if you take an owner's draw, that does not reduce your earnings, okay? If you do payroll, that does, okay? Keeping accurate bookkeeping is going to help with that. If you're kind of confused, like, hey, I don't know if this is the owner's draw or with this payroll, keeping up with it, documenting how the transaction took place and what was it used for is going to be one of the things that that works for you. All right. And what I want to do here is give everybody a 1 minute break, like 1 to 60 seconds, to go and stand up, grab some water or whatever. I'm going to use the time to stand up and to get some water. So so we're going to take a break because I know I can be very long-winded, and we're going to come back in 1 minute and just allow everybody to go maybe get a notepad, or if you had a question or a document that you want to ask at the end. We're halfway through. So I want to take this moment to kind of pause just for a second. All right, we're back. All right, let's get started. All right, so tax filing, bookkeeping tips, and some of this can be applied to personal tax returns. Remember I said you want to make sure that um you keep everything organized. I even if you had to put everything in a box throughout the year and at the end of the year sort it and put it together, that's more preferred than not keeping anything. All right, so for businesses, I like to encourage business owners to have a business bank account set up where you can use your bank statements as a method of bookkeeping. But I'm going to talk about a few things to help with that. So let's talk about bookkeeping. Record all of your earnings. Remember earlier I said we take the deductions after the earnings. So if you make the mistake of not recording all of your earnings, you may fall short because if your deductions are more than your earnings, your business will show a loss. And then also sometimes you may not have a way to verify how were you able to cover all of these expenses if the income wasn't there. So it's better to show all income and then use your deductions and your credits and expenses to reduce your tax liability versus saying, oh, I'm only going to report some of my income. It doesn't work out in the end. All right. So for example, if your business takes credit cards and cash and you only report what's given in credit and not the cash, that could set your business up for failure because at the end of the year, the numbers won't add up, okay? So you want to record all of your earnings. You want to reconcile your expenses in proper categories. Oftentimes on the profit and loss statement, which is your statement at the end of the year showing what your business earned and what were the expenses and all those things, a lot of times the expenses are put in the wrong category, which means you may not get the proper tax credit, or it can throw the your numbers off at the end of the year. And a good example would be gift. So for some businesses, there is where you would you had a door prize. I don't know, I'm just trying to think of an example, and you were raffling off a book. The money that you pay for the book, you may put it into office supplies versus under advertisement because the purpose of giving the book away was to advertise your business. Okay, so it would fit better under advertising than it would under office supplies. That was one of the examples I could think of. All right, so your travel expenses, some things go in certain categories. So you want to make sure that your expenses that you're reconciling are in the right category so that you can get the right tax deduction. And in case of an audit, it doesn't get removed. Like, hey, this is not what that was for. We're taking it off the table. Having a system or a method of recording is very vital, especially in this day and age. I know we come from the ledger generation. I still have a ledger for some stuff. Don't tell anybody. But we got to have a digital format. QuickBooks is one. There's another one called Wave App. I'm just going to use those two for an example for right now. I'm not endorsing either one. However, with QuickBooks, I am a QuickBooks Pro advisor. But my favorite would be Wave. So those are all personal opinions. I am not a paid sponsor of either one of those companies, so I'm not recommending. I'm just it's just an option. All right, so QuickBooks is great. It's a great software. It has stood the test of time. It's a household name. I mean, it's a great company. They have awesome customer service. However, QuickBooks is more for big business. And what I mean by that is QuickBooks was created by CPAs for CPAs originally. It was not intended for gig workers, entrepreneurs, small business owners. That wasn't the plan of it when it was designed. And just in recent years, it actually had an online version created. Prior to that, I want to say less than 10 years ago, the only way you could use it was a desktop version. But QuickBooks, the upside to it is it's an awesome bookkeeping tool. Like, it's like hands down. The con to that is you got to know how to use it. If you don't use it, one little thing could throw the entire, it just throws it all out the window. So you would have to be a person of financial understanding and terms and the interworkings of it. You would almost need to go through, I would say, if you're going to use QuickBooks, go through some QuickBooks classes. If you would like to take some QuickBooks classes, I have an excellent no-cost referral that I can send you through, where they do virtual classes on how to utilize QuickBooks. Reach out to me and let me know. So what I would prefer for small businesses, people that just getting started, or people who need to start over, like you've been in business 10 years and it's just all everywhere, you just so unorganized, or you're just still trying to figure that whole thing out, would be an app called Wave app, WAVEAPPS, all one word. The logo is blue and white, I believe. It is designed for entrepreneurs, small businesses, gig workers. It has more of a digital application to it. You can use it on a desktop or your cell phone. It is more user-friendly for someone trying to figure it out who is still currently winging it. But it is also good for those that have been in business a few years and who kind of got this thing under control. It has an awesome bookkeeping component. And the caveat to that is, my favorite thing about it, there's a free version and it does everything that you need. Whereas QuickBooks, you have a subscription, and and for those of you who are here on the Zoom, I will put it in the chat. And then those of you who are watching the replay, just reach out to me. If you're watching this on a social media platform, if you put it in the comments, I'll respond. But that is the app for those of you who are here with me currently live on Zoom. So you want to have some sort of bookkeeping method that's going to help you generate a profit and loss statement at the end of the year. That's the whole goal of that. You want to select a software or an accounting method that fits you. Don't use something because somebody else said this is what you should use. Check it out. Read how it works. Get a feel for it. See if there's a trial version of it. See if there's something that you're going to be consistent with. Because the key to bookkeeping and having a good P&L at the end of the year is consistent. How consistent were you using this all throughout the year? If not, you're going to find yourself in the month of December up all night trying to get this all ready for your tax professional for the first of the year. So pick something that you're going to be consistent with. If you're going to use a ledger because you're saying, hey, I will be consistent with pen and paper, then so be it. Just know at some point you're going to have to convert all of that into a digital format so that you can give your tax professional a 1 or 2 page profit and loss statement. Yeah, I still have people that come to me with the shoebox of receipts and things, but you best believe, not just me, but any tax professional that you know, we charge to go through those shoeboxes. It is a world of a difference than handing us over one sheet of paper saying, hey, these are all of my expenses for the year. This is the total of my income, and this is my these are my tax forms that are required to be filed with it, versus coming in here with a shoebox and I got to go through that and short that. So you're asking me to do 12 months of bookkeeping in a short period of time. So you do the math. So that's that. Do your bookkeeping as if you were going to be audited. I call it audit prep. Already go in it with the mindset of, if the IRS wanted a copy of my bookkeeping, I got it organized. Put it together in such a way that it is audit proof. That's where, if you need professional help with that, reach out to your tax advisor, your tax professional. They can help you structure that together, because there are some things that you can have things put in place a certain way that'll make this very seamless. It's not, well, I'm not going to say that. It's easy for me. So if getting organized and getting tax forms and all that together got your head hurting already, then you know that, okay, I need to maybe reach out to somebody to help me. Tax, so a lot of times people just think, okay, I got to file my taxes at the end of the year. I need to file a 1040 or I need to file an 1120, whatever the case may be. But that's not just the case in all cases. If you are a business owner, gig worker, entrepreneur, whatever the case may be, and you have an S corp, you have a corporation, there are some taxes you have to file throughout the year. There are quarterly taxes for income. There's state, federal, and local. So your federal taxes is one tax that you owe. You owe state taxes, and some local parishes or counties have taxes as well. And generally, there are quarterly taxes. Now, yes, you can wait till the end of the year to file all of your taxes, but you're going to have, when it comes to income, so now you're going to have different penalties. So if you ever notice on your tax return, if you file once a year, somewhere in that Schedule C, it will say underpayment penalty. And that generally ties back to the fact that you didn't file quarterly. Filing quarterly does save you on taxes, and it does get you ahead of it. So, it's an option. Sometimes people look at the number and they say, well, I'll just deal with it at the end of the year. The penalty is not that much. And generally it's not. It's usually a small amount. If you have tangible items in your business that you sell, so let's say you have a hair care company where you sell hair care products, your sales tax are due monthly, all right? If you have a service-based business, let's say you wash cars, you have a mobile detailing company, and you're not selling any products, you're just providing a service, then you do not have sales tax. But if you are selling products, tangible products, where you're giving someone something tangible and they're taking it with them, you are required to do sales tax, and those are due. Those are usually state taxes that are due monthly. Then you have your unemployment, workman's comp, general liability, or just some of the insurances, but those do factor in with your taxes, especially for the expense. And some of those are required. That's more into, I don't want to get too much into business setup because that's a different course, but today we're going to kind of stay focused on all the tax stuff. You have your annual income tax, which is what we were just discussing. Your profit and loss statement is usually great to have for that. And credits. Don't forget to calculate and keep all of your tax credits that you could potentially have at the end of the year. And we'll get into some of what those look like. All right, so I'm going to cover a few expenses. Of course, this is not all. This list could be 2 miles long. In the word miles is not on here, so you can claim business miles. But I'm just going to go over a few of the deductions, and no particular reason. These are just the ones that came to mind at the time. Cell phone, be very careful with that. If you use your cell phone, your personal cell phone for business, or your business cell phone for personal, meaning you got one phone number and one phone, you want to be mindful that whenever you're sharing, use the 80-20 rule. 80% of that cell phone bill is for personal, 20 is for the business. That is not an accurate, I'm not gonna use the word accurate. That is not a set in stone number. That is just a good rule of thumb, good practices or best practices. Because even though you use your business your cell phone for business, chances are you use it to make phone calls, calling home saying, hey, what do you want from the grocery store? So you don't get the tax credit for personal calls, but you do get it for business. If you have 2 separate lines and one is just for the business, then that entire bill is 100% tax deductible. But if you have one phone line, that one phone line is not 100% tax deductible. 80-20 rule means you'll do okay in an audit. They're less likely to flag the phone bill deduction. All right. Food and travel. If you are traveling or you're having a meal with a client, or you're traveling, you've taken your team, or you have taken your employees or your fellow business partners that you do outsource business with on a trip or an event or a function, there must be at some point a level of discussion around the business at hand, the business that is taking the deduction. There has to either be a meeting, there has to be some sort of activity, something that verifies that the only reason that we're all here is because of the business. All right. Now, of course, you're going to do other things, but if you're taking a client out to dinner as an appreciation, or you're trying to acquire one of their accounts or whatever it is, and you're in exchange, you're taking them to dinner to have this meeting because maybe you want to have it outside of the office. That meeting has to have some sort of discussion, business card, PowerPoint, I don't know, whatever you want to do, there has to be some discussion around the business in order to write that off as a business expense. Workshops, anything for professional development. If I was to charge for the class that you took today, because normally I do charge for the class, but if let's say today you paid for the class, you would be able to write that off 100% on your business tax return. If they're online or in person or hybrid, whatever the case may be, anything that you enlist in to help you better do your business, you can write that off on your taxes. That also includes if you send an employee to a training workshop. All right, office rent and home base, the differences between those two. I actually have an office and I have a home-based office. So both of those have deductions. Office rent, 100%, hands down, no questions asked. Write that off on your business taxes. Home-based get a little bit different. There's I did a whole session on home-based business. I may get a chance to do that before the year is out, to kind of be on the lookout for that. But home-based business, you only get to claim the deductions that are allocated to that room that you're using. So you would need the total square footage of your home and the square footage of the office space that you're using. So for example, for me, I actually have a home office in my home, but I can't claim the entire square footage of the home. I just need to know that for record keeping. I only get to claim everything that happens in this, I don't know what this is, an 8x10 or whatever it is, that square footage. I get to use that for my home-based business. Everything that's in it. Furniture, computer, internet usage, a percentage of it, percentage of the water that I just went and got some water. So all of that, you have a percentage that you get to use for home-based business. All right. Contract labor versus employee. If you are giving someone a schedule and they're using your product, they are an employee. They are not an independent contractor. You cannot give them a 1099. You have to issue them a W-2. Me, for example, for my business, I issue myself a W-2 and a 1099. So it just depends on what function I'm doing. I give myself that goes under my W-2, that goes under my 1099. So for you, if you have someone that coming into your business and you're telling them, hey, you have to be at work from 9 to 4 p.m. every day. This is your schedule. Here are the tools that you use. Here's the computer to do the work on. That is an employee. An independent contractor is someone that you make a contract with that says, hey, I need you to paint my home, or I need you to paint my office. And they come and they do the service. They bring all of their own supplies. They do the service. They give you an invoice. The business pays the invoice. That is considered 1099. Independent contractor, or that you outsource the services, business, or we call it business to business. Whenever there's business to business, then that correlates into a 1099. Payroll, I got W-2 versus 1099. We kind of talked about that already. Make sure that you are paying yourself some sort of way. It is not required for an LLC to have W-2 or 1099 reported. You do not have to do that. You can do owner's draw, but we talked about owner's draw. The drawbacks to that is you don't get to reduce your tax liability. So that's why I am in favor of doing a W-2 or a 1099. However, if you are an S corp, you are required to issue 1099s and W-2. The owner of it must have a W-2. Somebody has to work this S corp. And your shareholders have to get their tax forms, their K-1. So marketing and advertising, that often gets overlooked when I'm talking with clients and they're following their small businesses. advertising and marketing, even business cards, that's considered a tax deduction, and that falls under marketing and advertising. Boosting your business on Facebook, paying for the, you know how to actually you want to boost this post, that is marketing and advertising. That is one of the things that get overlooked a lot. Photo shoot, the clothes you bought for the photo shoot, paying a photographer, things of that nature. Paying for social media content, buying a content calendar, all those things play a part into that. So these are just some of the deductions. Like I said, there's a list a mile long that you could use, but I just wanted to highlight some of them. Why you would want to make sure that your business have these different functions. These are all tax deductible. This is not everything. I just wanted to kind of talk about a few more deductions. Your tax professional that you pay a tax filing fee, that is tax deductible. If you have a creative director, like I just mentioned, any of your marketing content, all of that is tax deductible. Client, anything that you do for your client above and beyond them paying you. So for example, if a client does not pay their invoice, you can use that invoice as a tax write-off under bad debt or accounts receivable unpaid. Different couple categories you can do that in. Or if you gift an employee and say, a client say, hey, look, I'm going to offer this service for you at no cost. You can gift that service, and that is a tax deduction. Your admin staff should have a W-2. That means the person that's making phone calls for you, things like that. There are other ways you can pay them as a 1099 or a W-2. And so you got a couple of options there. Just depends on how, if they have an admin company and you're outsourcing them, then that would fall under a 1099. But if they're in your office making phone calls, punching a clock, they are your W-2. They are your employee. They need a W-2. Your financial advisor typically are paid by the company that they advise you to use, but any money that you pay in exchange for advice, don't forget those things are tax deductible. I got owner mindset here. I want you to start thinking like, if I own this major retail store and I walked into the store, I have to look around and count everything that I spent money on. Don't forget, just because you're a small business owner or a gig worker or you're thinking about it, treat your business that way as an ownership. You are the owner, and that means you're responsible. So don't leave things off the table, and don't forget to claim all income. As an owner, as a business owner, you're responsible for everything. So take full advantage of all of your tax credit. All right. Oh. All right, so some of the advantages of having a tax professional, we prepare return, we provide tax planning, strategy advice, and this is not just me, but of course I'm going to ask for your business, but why you would want to get one, okay? They can represent the client before the IRS, which is no fun because, yeah, you want somebody helping you with that. So I'm all I'm going to say. Tax laws change every year, especially in an election year where there's a new party. So let's say we go from Republican to Democrat or Democrat to Republican. Usually the tax laws change as well. So they, not all of them, but they'll implement some changes because each party wants their agenda pushed. So for example, the last administration of Obama, we had where you can claim your homeowner's insurance, and it had like how long that law would be in effect. Well, a few years ago, maybe 21, the tax credit expired. So now you can't claim your homeowner's insurance on your tax return. Well, preferably the next person that comes in office puts it back. So that's one of the ones that I can think of. I mean, there's several. So sometimes that's why we say voting is so important. So if you're here in Louisiana and it's November 18th when you're watching this, make sure to go vote today. I'm going after this class. But anyway, you want to make sure that you understand the policies of that party, whether it's Democrat, Republican, whatever your choice is. They have tax codes that they want to implement or take away. So that's where your congressman and your House of Representatives, they play more of a vital role in that, because those are the things that they're arguing over. And I'm just calling it like it is. They're saying, should we tax for this? Should we tax for that? Should we not tax for this? Not tax for that? So every time there's a change, tax professionals have to keep up with that, which is what I know I can speak for the majority of us. We're keeping up with that so that we know that when our clients get ready to file taxes, they can now take advantage of new tax codes, or hey, that tax code is no longer available, such as claiming homeowners and insurance is taken off the table as of right now. So that we keep up with that. Take a picture of the screen if you like. We provide guidance on what tax deductions you can or can't take, maybe some things to consider, because sometimes we don't know everything, we kind of overlook it. So when you're meeting with your tax professional, I can say, hey, did you think about this, and do you have this? Because certain situations will call for certain tax credit, and if you check one thing, it may lead to you having a credit on something else. So that's another reason why we're going to make sure that you stay in compliance, answer your questions. We can also give advice about financial decisions such as investment and estate planning, which is very vital. You want to talk to your tax professional to find out, hey, if I put this investment in place, or if I do this in my estate planning, what are the tax implications of it? So you want to make sure that you talk to your tax professional when you're doing any major changes such as that. And we want to make sure that you have a good financial literacy understanding. And I'm going to throw this out there. If anybody that is on here do not have this book, let me know. I want to get one to you. This is How Money Works, and it can help you in that as well. Thought that'd be a good place to put that. All right, so got a couple more slides, and then we'll be taking Q&A. All right, so tax planning. It helps you minimize tax liability, but it also helps you maximize your tax savings. It makes sure that you're taking advantage of all the tax deductions and credits that's out there. It helps you avoid penalties and interest charges for late or incorrect filing. Sometimes if you file on time and then we go back and you get audited and it's all messed up and we got to fix it, now you'll learn that if you're going to owe more, they also add the penalties on that as well. So they go back, they retroactive that. And in the same thing, if they owe you money and then they find out that they should have paid you in a certain time, you do earn interest as well. So it does go both ways. It's just that their interest is way less than your tax penalty to them. I'm just saying. And there's some other things that why you would want to plan. Planning early also keeps you organized, and it also lets you know if your business is making money, and it shows you where you need to make adjustments. Putting a good business budget in place is good. Having a business plan is great, and making sure that you include your tax strategy inside of that. Having a business mindset, we talked about that. I want to make sure that you guys take a picture of this screen as well. You want to be proactive. Don't wait till the last minute. Start thinking about doing your taxes. Keep up with your tax records. Be organized. Be aware. Stay up to date on the tax laws. I watch a lot of financial shows. I know that doesn't sound exciting, but and I read a lot of books about it, and then I keep up with the latest changes. But this is something that you can do as well. It just makes for a better marriage with you and your tax professional if both of you are on the same page. And you want to be honest, truthful, and accurate, because look, numbers don't lie. And at any time, records, with numbers can come. It's better for us to help you work on tax deductions and tax credit with the real numbers versus without the real numbers, because one undoing of anything in an audit can lead to more tax penalties and interest. The third thing I want you to take away for today as a solution, text the word tax, TAX, to 985-326-9297. And I want to send you the link where you can register for a no-cost consultation or attend some more virtual workshops. I'll be doing different topics throughout the rest of this year. Some will be for financial planning, some will be for taxes, and then some will be for all different sort of topics like legacy planning, estate planning, tax planning, you name it. Anything dealing with money, I will be covering some of those topics throughout this time. Let me check. All right. All right. So, I already did that one. I'm a little arrow. Doesn't want to go the way I want it to go. All right. So maximize your success, plan, and strategize for a stress-free tax season. Don't leave your legacy to chance. Instead, take a proactive approach and plan ahead. This will help you leverage a stress-free tax filing season to your advantage. All right, so I want to open it up for Q&A. Just give me 1 second. I want to stop the recording. So I want to thank everyone that's watching the replay. If you have a question, you can simply email me, you can text, go to our website, martinbusinesssolutions.com, and there you'll find out how you can contact, send emails, register for a class, or anything of that nature, how we can better serve you. And I thank you for watching this replay. Make sure that you like, share, comment below where you're watching from so that we can better serve you. And so I thank you for that. And so those of you that are here on Zoom, hang on 1 second. We're going to do Q&A. I'm going to stop the recording.